Johan, one of the new policy that will kick in at the start of 2017 is the removal of the mandatory rating for issuer who wants to access the market. I'm wondering, from your point of view, how will that impact the market?
I think our regulator have started this exercise almost 2 years ago,
Yeah,
preparing the market for a removal of mandatory rating for the bonds issue in Malaysia. This is part of liberalization of our market. Effectively, that the demand of the bonds dictated by investors like Michael, and the rest of the other investors, so that if the investors are comfortable that they're able to buy bonds that are unrated, these are typically for stronger credits, more for corporates. So say, for example, let's say a strong public listed company that has got a lot of disclosure of information and the financial in the market. If they are able to do a private placement of, say, equivalent of, say, 200, 300 million US dollars of their bonds in the market without rating, then provided that the pricing is competitive, then there's no reason for them to compel themselves to get a rating. Or there's no rating agency here today, I hope. They are effectively, the investors now saying that if I can evaluate the credit on my own, I should price it, the credit, and the issuance based on their internal rating. I think this is something that the market is moving towards. So it shows that the market is developing. The next question is, how will it impact the market? I think for project financing and for more complex structures, you still need rating agency to actually do the rating. But for credit, well-known, for example, even multinational, let's say Coca-Cola decided to do a bond issue in Malaysia. So if they are rated by Moody's and S&P globally, there's no reason for them to actually get a mandatory rating locally. But currently they are. So I think they will actually promote further issuance and capital markets growth. The next question is, will there be liquidity for investors who currently have mandates investing only in rated bonds? So, I mean, to me, the liquidity will work itself gradually, with bigger fund managers ready to buy the unrated bonds and the banks. So I think currently my team, we have done multiple transactions. So one of us for the telcos with good cash flows. We're doing bond deals up to 10 years unrated. So effectively for financial institutions, investors, it's fairly like you're moving from the convergence of a loan product and bonds, tradable bonds, to unrated tradable bonds, which is somewhere in the middle, product-wise. It's good. I think it's very positive.
Yeah.
I do agree with Halim about the forecast of the volume and the correlations in terms of what the issuers will expect. 80 to 90 billion seems a very sensible number.